thanks for the opportunity to take up some of your time. I'm not sure whether I can fill up 30 minutes, but what I really wanted to explain, or put my view if you like, is what I see as the reason or the basics of our inflationary problem that we seem to have had over the last, well, particularly my lifetime, but according to my old father, it happened over his lifetime too. And when my father first went out to work, he told me he was on a pound a week, breaking rocks. So, you know, we've seen huge inflation over the last century. But yeah, what I'd just like to reflect on is, firstly, if we use the example of, we can use the Guernsey Island experience in 1815, and yes, it was in the New Times survey, so you may have read it, but we'll just basically go through it. 1815, the people of Guernsey Island wanted a marketplace. Now, they only had about £1,000 of English money in their coffers. It was going to take £5,500 to build this marketplace. And they didn't want to go into debt, so they decided, the authorities there decided what they would do is actually get the printing press going and print £4,500 of their Guernsey money, Guernsey dollars if you like. And it worked fairly well. They proceeded to carry out the works and bought all the materials. That was the factors were that they had the manpower that they needed, and they had the materials, or could get access to the materials within their own land. And so all they really wanted was the money to make it go. So having got the printing press going, the job proceeded. It was successful, I believe. But at the end of it, like, the people were quite happy to have this, and they were quite prepared to pay, rental or a tax, if you like, for the use of the marketplace. So the authorities decided that so that they didn't leave this money permanently in circulation, to devalue their currency, if you like, it would over time be removed. And that's how they did it, by charging a small fee or a tax for the use of the thing. Now, over a period of time, I don't know exactly how long it took, but over a period of time, they'd removed the whole of the £4,500 they printed. So they're back to the same level of money around the areas they had previously. But the wonderful thing is about that while that money was in circulation, people could use it for other trading. They could trade among themselves using their Guernsey dollars. And, and the point being, what the authorities did, of course, was, when I was telling one woman about it locally, she said they wouldn't burn money. Well, that's exactly what they did do. It may have been worn out, but nevertheless, it had served its purpose. It had done the cycle. And that's the thing about money. As we understand here from yesterday, it comes mostly into existence as bank-coded credit. It does a cycle, and then at the end of the job, it's extinguished and goes out of existence. That's in the case of credit. If it's paid back to the bank, I'll get onto that later. But this money is a cyclical thing. It does its job and then it's finished with. Now, whether the Guernsey Island people had to burn their money is probably their decision. They could have just shoved it in the drawer and put it into the circulation for the next job. Now, that was the Guernsey Island experience. They ended up with no more money than they started with, but the job was done, everybody was paid, and there was no debt because there was no interest. That's the point. There was no interest on that created money. Now, another example we can look at, England during the term of the tally stick system. Now, from what I read on that, England, for a period of 500 years, a loaf of bread cost the same. Wouldn't that be marvellous? And from what I read, it went basically from the 1200s through the 1600s, so 12 to 1700 sort of thing. Now, when you think about that, although the connection wasn't made in the book I was reading on it, it basically, from the signing of Magna Carta in 1215 to the formation of the Bank of England in 1694, so that's a 500-year period. They had no inflation because with the tally stick system there was no provision for interest. So, it's my feeling that it's the interest. Now, if you look at today, we've got a system where as we understand, most of our money is created as a debt to bankers, but they always attach interest to it, or generally, and it may be higher or it might be lower. I think it's determined by what they reckon they can get away with, actually. But yeah, there's certain requirements, government requirements. At one stage, the banks were required to, hold a certain amount in reserve, the statutory reserve deposits. But again, a book I got from the Reserve Bank back in 2000, I find that at about 1988, I think, when Hawke's Lot deregulated banking, where it had previously been about 4%, meaning, I suppose, that if the banks held so much or issued so much in loans, had to hold a portion of it, a percentage of it, in currency. Well, in 1988, that statutory reserve deposit was made to zero. So you can work that out for yourself. But then there's also another factor that limits or governs what banks can lend, and that's called, now what's that called? The credit multiplier ratio. And I don't think there's any legislation that provides for it, but from what I read on it, banks can lend, or will lend, a multiple of what they hold in securities. Now, those securities could be deposits or people's, their mortgages, etc., their titles and their other valuables. From what I read on it, if you ask the bank's chief economist what their ratio is, their credit multiplier ratio, it's generally between 12 and 20 of what they hold as securities, what they'll lend as credit. Now, what got quite interesting, you people might be interested, in 1988 the Bank of South Australia came unstuck. What they was doing was issuing what they called simulated overseas loans. They even gave you a certificate, or the borrower certificate, simulated overseas loan. Now what they were doing was actually charging all the appropriate fees and interest as if they was actually going somewhere and getting something. But they wasn't. What they was doing was increasing the credit multiplier ratio. And they pushed it out to 160 to 1. Worked that out here. Well, of course, in the end, they realised it was going to bring them unstuck, and it did. But in the year before it all come tumbling down, they decided to pay their board of directors $1 million bonuses, and they get away with it. What I'm saying is, as we understand about bank-created credit, at the end of a loan, the principal, if it is repaid, is extinguished, goes out of existence. Now, even though you've paid it to the banker and you haven't got it anymore, he hasn't got it either. If you can get your mind around that, it's because the credit line has been extinguished. You've taken back your security, perhaps your mortgage on your property's been, your title deeds have been returned to you. The banks no longer have the ability to issue credit against that security. So the money has gone out of existence. And that's what Douglas, I believe, found, was that as industry prospers and pays off their debts, all of a sudden there's no money about. It's all been gone back to the banks and they've extinguished it, just like the people at Guernsey stuck it in the incinerator. Quite a bit different that banks are talking about credit, and some people might say, oh, but I paid it back to the bank in money, currency. Doesn't make any difference, only bookkeeping to them. It's just one type of, one column in their balance sheet, if you like, or on their computer against another, and they just balance them off against one another. If it's not currency, it moves into something else, But that's their bookkeeping. But now, there might be some that disagree with me on this, but the way I see it, the principal of loan, because when the principal is issued, the money to pay interest is never issued. So where does it come from? It's got to come from the principal of other people's loans. So that means when one person finds $1 to pay the banker his $1 of interest, somebody in the system is going to come up that $1 short. So there's always that shortfall. Now the banks, because they demand this, and don't forget, it might only be a few percent, over the period of a loan, it could be 200 or 300% over the period of a 20 or 30 year loan. So the way I see it, the interest is never extinguished because the bankers have pulled it out and given it to their shareholders. It is their profit. It's what they do. It's their legitimate income, the interest. Now, it might have moved into their fortunes and not be in general circulation. Nevertheless, it's added to the money supply. So that, to my way of thinking, there's an equation between the interest banks charges and the inflation rate. If you take, or if you accept that increasing the money supply devalues the money supply, well, that's what it's doing. They're adding to the money. And where did we just hear yesterday? They're creating or increasing their debt by close to $500 billion a year now. So, to my way of thinking, it's mainly because of interest. The biggest part of our tax dollar goes to service debt. They don't want us to pay off the principal. They just want you to keep paying interest. So that's what I think is the cause of inflation, is interest, because we didn't have it in the totalistic time. Guernsey Island didn't suffer it because they didn't charge interest, but our lot do, and we're just seeing continuous inflation. And I think it ought to be changed. So.
Thanks, Rod. Now, I'm speaking as a dairy farmer, and I listen to you. So I'm down the sale yards, leaning on the fence, and I start telling my neighbour who's there to buy a few cows what you've just said. Now, I don't think he's going to listen too hard to me if I start talking about money. But if I started talking about cows and inflation and translating it into something that is in the farmer's realm, it doesn't matter whether it's cows, acres of wheat or whatever the farmers do. Now, 50 years ago, 47 cows, and I speak from experience, would maintain a family, a farm. They took the production from the 47 cows, put it into the national pool, and took back a standard of living, a good standard of living. Today, it takes 10 times as many, 470 cows. Life is not as good. Now, that is a form of inflation. And I can say to the farmer, where the hell has the production gone from all those other cows? And then we might be able to talk about money, but we've got to get down to the practical application of the real world that people understand. And I find talking about money, you've got to start somewhere within the realm of your listener. I don't know whether I think you've got to relate inflation to practical terms. The housewife knows that about inflation, and I've been to the local market handing out pamphlets, but when I go to the talk to the stall holder, they're as busy as hell trying to make a dollar. But I say the rising prices for you for your basic inputs make much difference on your business. Do you have to keep putting your prices up? And we start from there. You don't need to give people a lecture on money, on banking and that sort of thing. But if you start talking about the number of cows or the number of acres of wheat that you've got to grow to pay your taxes and every other darn demand on you, you're talking at the practical level. It's not, I agree, but it's not, I don't think for us, we're into communications and we've got to communicate at that level, the lowest level going. Anyway, thank you.
Thanks, Lou. Yeah, well, I do that quite often too, and I relate it again to our personal experience. With my family in the 1940s, moved onto a property that was only 100 acres and mostly uncleared, and they had to clear it and develop it. They didn't have a lot of money for sure, but in the mid-1950s, I was born in 1946, but in the mid-1950s, my father could afford to go and buy a new FJ Holden and a new little international tractor, and they wouldn't have been going into debt, don't worry. And they were doing that milking about 20 cows. They never got up to milking about 40, even at the finish. But during the time, every couple of years, Dad would clear about another 5 acres. It took him 30 years,
Exactly.
you know, to develop that little 100 acres. But we never went without shoes and never went without food. And, you know, we didn't have mobile telephones and TVs, and that, but we didn't need them because we didn't know what they were. But we were doing all right, I think. Yeah, but now it's just like you say, Lou. Most of the dairy farms in our area, where there used to be 30 odd, there's now about 5 or 6, and they're big operations, and they're getting bigger all the time. They want more land. It always makes me say, why do these farmers continually want to get more land? I suppose they're forced. They've got to pay their banker, haven't they? I don't know. Yes.
I always look at it from the point of view of America. To me, in history, was the most productive nation in all of recorded history. And yet it has, I think it's $100 trillion or $70 trillion debt at the moment. How come? No. I see it from the point of view physically. Physically, they could not only produce for themselves, but they produced for regenerating Germany, different countries, and yet financially, the huge debts. That to me makes more sense. And when it comes to, there's a book that I spoke about yesterday, this David Graeber book, and he's dealing with debt the first 5,000 years, and he's taking about. What I found fascinating was that the terms that religion uses are the same terms as the commercial world use. Redemption, sin and debt, it's all there. And it seems to me that now when I look at the New Testament, I realise that it was written in the time when, of course, the Roman civilization was at its peak, but it was also at its peak with its huge debts. And so people would have understood that it wasn't just personal salvation that it was talking about. It's talking about physical salvation. And I think we have to relate some of these things to understand, you know, that we're missing the points. And when it comes to in 1000 AD, the church and the state combined under the kings in England, and they supplied the money supply for the nation as a whole, and the money supply had to agree with what was physically needed, what was physically produced. There was no such thing as debt. For 200 years, there was no such thing as debt. We have to look at some of these historical examples to understand we're missing the point.
I often do say to people about even Douglas, when I first started reading some of his writings, that Douglas said, it's a physical impossibility to live beyond your means. And I thought, oh yeah, but hang on, we're all saying that, we're living beyond our means. But he said physical, not financial, and that was the difference.
Right. And you as a farmer, Rod, would well understand you cannot produce this year's or this season's crop with next year's rain.
Well, I think one of the ways Douglas put it back was it said that you can't eat next year's grain crop this year or drive next year's motor car. This year you can't do it.
So physically, we're producing more than enough. Probably they're trying to get.
But then you come to the debt, and I do talk about America. I say to people, in a physical sense, America is the richest nation on the planet. Why are they bankrupt virtually? Well, the way I say is simply because the token that represents that wealth is issued to them as a debt with interest attached.
Well, that's right.
The debt has been created. It doesn't, what you're talking about, it doesn't represent the physical reality.
And if Christians don't understand it, how the hell is anyone else going to understand it?
Well, it's pretty hard to get it over there. I do try to talk to people about it, and they say, oh, it's so complicated. When you talk about money creation, I say, no, money creation isn't complicated. What's complicated is getting people to understand how simple it is.
Well, that's because we have been conditioned. And as far as I'm concerned, the church has a lot to answer for that.
I'm not very good at public speaking, so I'll just say what I'd say what you are talking about is the missing link. Now, that's the interest and the charges, and that's got to have money created, debt-free money, to pay for the much talked about now, I suppose everyone has been hearing it, the unconditioning wage, because we're overproducing, and it's not just keeping producing, as Mr Turnbull says, to get out there and work harder and find new industries and all this sort of thing. Well, really, we don't need any new industries. We've got enough. We've got far too much made already. We've got far too much wheat. We've got far too much wool. We've got far too much everything. We haven't got enough credit or money, and that's when money's got to be brought into a debt-free, and everyone needs an unconditional wage.
Yeah, when Douglas pointed out, or, come up with his A plus B theorem, it's that shortfall in the system. We all understand the A plus B here. I don't need to explain it, I guess, but it's that shortfall in the system that we required, and interest is one of those extra costs. You get interest and taxes and depreciation and company profits and research and development and all that sort of stuff. It's all above what's put into circulation, as Douglas called, purchasing power. So where do you get that from? You've got to get that from exports in the present system. So we're driving this export market all the time to try and make up for the shortfall in our domestic economy. So it's quite crazy, really. Yeah.
Ken started off talking about policy, and now Rod's talking about money. I have a favourite trick of asking people, what is the financial policy of the government towards its people? And it's most interesting. The financial policy of the government is to see that as few people as possible become financially independent. And why? You cannot buy votes from people who are financially independent. The government keep people down by a myriad of taxes. They tax you in every way possible to see that you don't become financially independent. They don't mind the odd person who wins the big lottery, because if it doesn't destroy them anyway, they spend the money, but they're only one or two. But the multitude of people are financially kept down. And when you talk about inflation, it's the GST is a classic example of inflation built into the system. We need to know what the policy is and how to counter it. Now, I think we've got to get a bit more, we've got to get practical, and we've got to try and communicate that with the people who don't understand. And one way, they all know they're being taxed, and I always remember Jeremy Lee, he used to say something to the effect of, they'd say, oh, you're being negative, we're all being negative. He said, well, we'll illustrate that. He said, all put your hands up who want to pay more taxes. Who's voting no to more taxes? Well, no, who's voting yes for more taxes? And nobody puts their hands up, you see. So it depends on how you ask the question.
The thing that gets me is because we understand now that the money to pay the interest was never circulated. So the system really demands bankruptcies. But it gets interesting in my way of thinking is when a bank is forced well, I suppose they call it to foreclose on somebody, but they'll do it even when not necessary. Once they've decided to take that step, they'll foreclose whether you can come up. And I've seen that in our local area. Guy came up with the money, no, too late, it had gone too far. They foreclose, and when there's you will notice when they foreclose on somebody's property, they're quite happy to sell at less than its value. And the way I see the benefit to the banks, foreclosure or bankruptcies are profitable to bankers, and this is how. Only the principal of the loan is extinguished. I claim that. In this case, if you've got a bankruptcy and the property is sold, any recovery must be paid off the principal of the loan and is extinguished out of existence. But any losses, what does the banks do with that? They offset it against other income, don't they? So there's a paradox in this. If they offset it against other income, providing they've got other income, they might come when they won't have, where do they put it? Straight in their back pocket. It's a profit. That's why banks make record profits when everybody's going broke. They don't like it when you question them about all this stuff. I've had blokes, treasury guys, go all wimpy and say, well, yeah, right. But one fellow said, but that's not money. And I said to him, well, we're talking about bank credit. And I said to him, if it's not money, tell me this. How come we have to pay tax on it? And then the Lord helped me, and it suddenly occurred to me. I said, you fellas even accept this stuff in payment of taxes. And he didn't answer me. But the colour went clean out of him. He went white as a sheet. So I don't know what that meant, but he didn't have an answer. But he confirmed everything I was saying about how banks create credit and extinguish credit. But that's not money. That's not money. Well, I said, more or less said, well, I can't tell the difference. I said, why do we have to pay tax on it if it's not money? Well, you do have to pay tax on it. And like I said, it did suddenly occur to me, they accepted in payment of taxes. I don't think this fellow ever thought about that.